In the digital casinos of the modern financial world, where fortunes are forged and incinerated with the click of a button, there exist tales that defy conventional wisdom. These are not stories of patient, diligent investing, of index funds and dollar-cost averaging. They are fables from the edge of reason, born from the volatile nexus of leverage, luck, and sheer, unadulterated audacity. They are the legends whispered on forums and flashed across social media feeds, showcasing the highest highs and the most gut-wrenching lows of a generation that treats the stock market not as a retirement vehicle, but as the world's most exhilarating video game. Our first story, a masterclass in unintentional high-stakes gambling, begins with a seemingly modest strategy. A trader, let's call him the accidental titan, decides to sell 1,000 put credit spreads on the SPDR S&P 500 ETF, colloquially known as SPY. To the uninitiated, this is a sophisticated-sounding option strategy, but its premise is deceptively simple. By selling these spreads, he was effectively making a bet that the SPY, a broad measure of the U.S. stock market, would not fall below a certain price by a specific expiration date. The mechanics were straightforward. For each of the 1,000 spreads, he sold a put option at a specific strike price and simultaneously bought another put option at a slightly lower strike price. The one he sold obligated him to buy SPY shares if the price dropped below that strike. The one he bought was his insurance, designed to protect him from catastrophic losses by giving him the right to sell those same shares at a slightly lower price. The difference in price between the option he sold and the option he bought resulted in an immediate upfront credit. In this case, he collected a tidy $2,000. To secure this trade, his broker required him to put up $50,000 in collateral, which represented his maximum potential loss. This $50,000 was, in fact, the entirety of his trading account. The goal was simple. If SPY closed above his short put strike price on expiration day, both options would expire worthless, and he would walk away with the $2,000, a respectable 4% return on his collateral. It was a high-probability trade, a routine way to generate income from a sideways or rising market. But the market is a fickle beast, and it has a special kind of cruelty reserved for those who believe they have it tamed. On the day of expiration, everything seemed to be going according to plan. The market closed, and the SPY was comfortably above his short strike price. The Titan breathed a sigh of relief, the $2,000 credit now safely his. But the story doesn't end when the closing bell rings. In the murky, thinly traded world of after-hours, a sudden, sharp dip occurred. The price of SPY momentarily plunged, like a stone dropped in a pond. In this fleeting moment of chaos, a critical threshold was crossed. The put option he had sold, his primary obligation, was now just barely in the money. His protection, the put he had bought at a lower strike, remained out of the money. This subtle distinction is where the gears of financial ruin, or in this case, improbable fortune, begin to turn. The anonymous buyer on the other side of his sold put, seeing the opportunity, exercised their right. They chose to sell their shares to the Titan at the agreed-upon strike price. This is known as assignment. Because he had sold 1,000 of these contracts, and each options contract represents 100 shares, he was now legally obligated to purchase 100,000 shares of SPY at the strike price. The total bill for this unexpected shopping spree, a staggering $23 million. Compounding the horror, his supposed protection, the long put options he had bought, were now useless. They had expired worthless the moment the market closed, and even if they hadn't, he couldn't exercise them to offload his new shares until the market opened the next morning. What he was left with was a financial paradox of terrifying proportions. A humble $50,000 account, now holding a $23 million position in the world's most traded ETF. To put the sheer absurdity of this into perspective, he was leveraged 460 to 1. For every dollar of his own money, he was controlling $460 of borrowed capital. It was a position so precarious that a gentle breeze in the wrong direction could have vaporized his account and left him indebted to his broker for a sum he could never repay. As the saying on the trading forums goes, it literally couldn't go tits up. If SPY had opened just 1% lower the next morning, a completely normal fluctuation, he would have been staring at a loss of $230,000, a devastating blow starting from a mere $50,000. He spent a sleepless night, his entire financial existence hanging on the whims of the pre-market session. But fortune, it seems, favors the bold, the foolish, and the incredibly lucky. As dawn broke, a wave of buying swept through the markets. SPY opened green. By the time his broker's risk management team frantically liquidated his monumental position, selling off all $23 million worth of shares, the price had ticked up enough to not only cover the entire cost, but to leave him with a profit of over $110,000. He had, through a terrifying brush with financial oblivion, achieved a 200% return on his entire account in a single day, with absolutely no idea how he had stumbled into such a mind-boggling scenario of infinite leverage. Such stories of accidental triumph are the siren songs of the market, luring traders toward jagged rocks of risk. They populate the internet, these spectacular screenshots of green numbers and 1,000% gains. Some are backed by meticulous analysis, but the vast majority, perhaps 99.5%, are the result of what can only be described as degenerate risk-taking. For every tale of improbable victory, however, there are countless untold stories of violent, life-altering implosions. And sometimes, the loss is so profound, so absolute, that it feels like the money itself has ceased to exist. This brings us to the story of a $4 million loss, a tragedy so complete it deserves a special place in the pantheon of financial disasters. This wasn't a slow bleed or a bad investment that might one day recover. This was a detonation. The culprit was a financial product with the ticker symbol XIV, a name now spoken in hushed, cautionary tones. XIV was an inverse exchange-traded note designed to do the opposite of the VIX, the CBOE Volatility Index. The VIX, often called the Fear Index, is a measure of the market's expectation of volatility over the next 30 days. When investors are fearful and uncertain, the VIX goes up. When the market is calm and complacent, the VIX goes down. A quick glance at a long-term chart of the VIX reveals a distinct pattern. It spikes violently during crises, the 2008 financial meltdown, the COVID-19 pandemic. But over the long term, it always tends to revert back to a low point. Calm, for the most part, is the market's default state. This observation was the foundation for an entire cottage industry of financial products. Since volatility seemed destined to always fall over time, why not bet against it? That's precisely what XIV did. By buying XIV, you were effectively making a bet that market volatility would go down. For years, this seemed like risk-free money, a golden goose. As the market entered a prolonged period of unusual calm from 2016 to early 2018, billions of dollars poured into XIV and similar funds. They delivered astounding returns, sometimes 3 to 10% per month, as traders collected the steady profits from a placid market. It was the perfect trade until it was. On February 5, 2018, a day now grimly referred to as Valmageddon, the market sold off sharply, dropping around 5%. It wasn't a historic crash, but it was abrupt enough to shatter the prevailing calm. The VIX, which had been slumbering at historic lows, woke with a vengeance. It didn't just go up, it exploded, shooting up over 100% in a single day. Because XIV was designed to do the inverse of the VIX, this catastrophic spike in its underlying index caused its own value to plummet by more than 90% in a matter of hours. The trader in our story watched as $4 million of his net worth was reduced to ashes. The particular cruelty of this loss, what sets it apart, is its finality. With a conventional stock loss, even a severe one, there is always a glimmer of hope. The position is unrealized. The company might stage a comeback, the market might rebound. You can hold on, pray, and perhaps one day make some of it back, but this was different. The mechanics of the XIV note meant that such a drastic single-day loss triggered a clause in its prospectus allowing the issuer, Credit Suisse, to terminate the fund entirely. The money wasn't just lost, it was gone. The fund was liquidated, its value set in stone at a near-zero price. This was the closest thing in finance to watching your wealth be utterly and completely deleted from existence. The screenshot of this loss is a work of morbid art. The figure, a soul-crushing loss of millions, is displayed in a cheerful, optimistic green. It's a final, dark joke from the trading platform, a small courtesy to prevent the immediate psychological shock from sinking in, a flimsy shield against the crushing reality of total financial annihilation. Witnessing these violent financial events, both the impossible wins and the devastating losses, forces us to ask a fundamental question. Why? Why would anyone willingly subject themselves to this kind of risk? Why not simply buy a broad market index fund, contribute to it steadily, and let the gentle, persistent tide of economic growth multiply your wealth 22 times over a lifetime? To those outside this frenetic world, the logic is baffling. But within the community of traders, there's an implicit understanding. Remember that for every violent loss, there is an equal and opposite gain somewhere in the system. The relationship may not be one-to-one. It's probably closer to 10 catastrophic losses for every spectacular win, but the principle holds. For every 10 financial futures that are snuffed out, there is one degenerate trader lifting himself from the trenches of mediocrity into a new, higher tax bracket. Gains are inherently more complex than losses. A loss requires only one thing, being wrong. A spectacular gain, however, can arise from skill, from luck, or most often from a potent and indistinguishable cocktail of the both. Imagine you gather 10 million monkeys, literal zoo-dwelling primates, and give them access to trading accounts with instructions to buy options. The resulting chaos would be a perfect microcosm of the retail trading world. There would be an ocean of 100% losses, accounts wiped out in an instant. But statistically, by pure random chance, a few of those monkeys would stumble upon 1,000% gains. One might accidentally buy call options on Tesla just before an unexpected rally, yielding a 100,000% return. Does that make the monkey a genius? Of course not. It simply demonstrates that in a large enough sample size, these extreme tail events become not just possible, but probable. The internet has created a global population of 10 million trading monkeys. Given this scale, it's inevitable that someone somewhere will hit the jackpot purely through luck. Consider the trader known as the Trivia Tribe, who bought Roku puts with only 1 day left until expiration. It was a lottery ticket, a bet that the stock would collapse in the next 24 hours. The next day, Roku's stock was annihilated by a bad earnings report. The trader casually 65x'd his money in a single day. In 99.9% of cases, a return of this magnitude is entirely attributable to luck. Had anyone possessed credible information that the stock was about to plummet, the implied volatility of the options would have skyrocketed, pricing them so high that such a massive percentage gain would have been impossible. Not content with this incredible stroke of fortune, the Trivia Tribe then proceeded to dump their entire $50,000 winnings into SPY puts, also expiring in 1 day. And somehow, lightning struck twice. This is the world of biotech stocks, a realm where such binary outcomes are the norm. These companies are home to the most powerful catalysts in the entire stock market. A small firm working on a new drug for a common ailment could see its value increase tenfold overnight with a positive announcement from a clinical trial. Conversely, a failure can render its stock worthless. This makes the sector a fertile ground for the kind of gambling seen on forums like WallStreetBets. In one instance, a company called Novacure jumped 50% in a single day after an announcement that the trial duration for one of its therapies would be reduced, a positive signal. Could you predict such an event with any consistency? The catalysts themselves are nearly impossible to time. Statistics show that only 9.6% of drugs that enter phase 1 clinical trials ever end up reaching the market. Hitting a lottery ticket like this is possible, but highly improbable. And even then, the victory can be fleeting. In the months following its massive spike, Novacure's stock fell 45%. In biotech, good news often just means there's a slightly higher chance the company will be worth something in the future. It doesn't guarantee any substantial long-term value. 1,000% gains from lucky bets are exciting, but there is a different kind of satisfaction, a deeper intellectual thrill, in seeing a trade with real intent and a well-formed prediction come to fruition. It's one thing for a monkey to get lucky. It's another for a trader to formulate a thesis, act on it, and be proven right. One such trade unfolded in December 2017. Congress had just passed a sweeping bill that significantly cut corporate taxes. A trader, poring over historical charts, noticed a compelling parallel. The last time taxes had been cut so severely was in 1986. Following those cuts, January of 1987 was an exceptionally strong month for the S&P 500. The trader's idea was simple, almost elegant. What if history were to repeat itself? With this thesis in mind, this degenerate investor bought $100,000 worth of out-of-the-money call options on the S&P 500, set to expire after January. This was a bold, high-conviction bet that past performance would be indicative of future results, a strategy that market disclaimers constantly warn against. Most astute observers would argue that if the tax cuts were public information, their potential effect should have already been fully priced in to the options market. How could one accurately draw a causal link between tax cuts in 1986 and a market rally in 1987 anyway? The trader, however, made it clear in his post that his bet wasn't based on a certainty that the present would perfectly mirror the past. It was based on the belief that the options market was significantly mispricing the possibility that it could happen. He believed the potential reward far outweighed the risk. As it turned out, his contrarian thesis was spectacularly correct. January 2018 became the market's best month in over 2 decades. His cheap, out-of-the-money calls exploded in value, 25x-ing his account. He locked in his $2.5 million in realized gains just before the Valmageddon event in February, a display of both foresight and discipline. From the dizzying heights of accidental infinite leverage to the abyssal depths of fund liquidation, from biotech lottery tickets to meticulously planned historical gambles, we have traversed the landscape of modern internet finance. It's a world that shows us, in the most dramatic fashion, that for the average investor, the most sensible path is likely the most boring one, to consistently put money into a low-cost index fund. Unless, of course, you feel lucky, in which case there's always an inverse volatility fund waiting for your investment.